Hey everybody, Preston Bryn here with our Trader User Group free weekly roundup. This is for the trading week ending January 13, 2017. What I've got on the screen here is a 2-hour chart of the E-mini S&P 500 futures. And you can see since about the first week in January, actually January 6th, we started a very slow, orderly down move, making lower lows as we kind of moved through. And then it ended here, the tail end of this week. And then we just started a slow, gradual rise back up. We broke this downsloping channel here, and we tested it here as well as a previous pivot point high here. This pivot point high here was the highs that we made in 2016. And you can see this is just kind of where we're sitting right here going into Friday. And you know, this movement here with this off of this low here around 22.48, and then in this tight choppy area here, the anticipation is for the momentum to carry us up and make new highs in 2017. Now, 2017, as you guys know, we're gonna see a lot of potential seismic shifts in the market. Everything from China to all across Europe with geopolitical risk. Obviously, the Brexit vote and how Great Britain operates and how they define the exit from the European Union. The euro, which I've always said is a failed experiment. I just don't see the euro going more than a couple of decades, if not even that. Populism can help push the euro off the table. And then we've got a very strong U.S. dollar. We got the Feds here talking about 3 rate hikes, possibly 4, but they've stated 3 for 2017. Just as a reminder, they said they were going to do 4 rate hikes going into 2016 on their first rate hike in December of 2015, and the markets proceeded to sell off to the February 11th lows in 2016. So we've got a lot of potential risk here, and not even mentioning, all of this without even mentioning the Trump administration and some of the things that he wants to do in a pro-capitalistic perspective, which would be very bullish stock markets. We've also got relatively high valuations in the S&P. Stock valuations, we've got a projection of a go-forward higher earnings per share for 2017, and in the bond market is off, interest rates starting to see the rise, strong dollar. So folks, we've got a toxic cocktail for 2017. There's going to be a lot of opportunities. As I said in Q4 of 2015, going into 2016, I'll say the same thing here as we start 2017. It's going to be the year of the currency, which is going to drive, which is being driven by interest rates, by central banks, negative rates in many places, as well as the fiscal stimulus that we're going to see here in the U.S. should the Trump administration get even half of what they want, tax cuts as well. Optimism going into the 2017 year is at elevated, very high levels for small business here in the U.S. More people are lining up in the bullish camp. So, you know, when you generally get one side of the boat tipping one way, you've got to be very careful, especially in the financial markets. That's just the way they work. But if you look at this 2-hour chart, this sell-off is very orderly. In fact, it's quite normal after the big move that we had. I think about 1.9 trillion in profits was generated globally on the markets after Trump won the election on November the 8th, starting on November the 9th. The markets, the S&P and the Russell, actually were in the red for the year on the night of the Trump election, and essentially made the entire return for the year in the last 7 weeks of the year, okay, and hit the highs. So 2017, as I said, is going to offer some great opportunities for us. And as I said, going into the holiday season a few weeks ago, we have, I highly encourage you, we had a lot of people come into our user group. I'd also encourage you to come in. We've also kicked off for non-members as well our secret trader where you guys can follow my trades. Now these are trades that I'm actually taking, so you can do it from an educational perspective or you can do it however you'd like. But as you guys know, we trade everything from the equities to the currencies to all the commodities, ag, energy, precious metals, softs, you know, like sugar and orange juice and several others. We do the meats, you know, and so we do a lot in this market. Why? Because we got a global audience. So we're playing the global markets, which is what you should be doing. But if we look at this, let's just get back to point at hand. If you look at this 2-hour chart, fairly orderly. In fact, it doesn't look like much. You can see the 2017 open price down here at 22.40. I've got in the blue dashed line here. And this is kind of where we're sitting. If I move it back out to a daily chart here, you can see here it's just all it is really. We hit the highs in 2016 on December the 13th. And then we started rolling back over towards the last couple of weeks of the year. Now I went flat right in that area right there in my portfolio. Generally, I don't like trading the last week of the year and the first week of the new year. I like to just take a break from the markets. It's always good, especially if you're in the markets every day, to just kind of clear the head, focus on other things like family and friends. It's a much better way to play it, and then come back fresh and clean. But you can see here, as I said last year, going into the hitting the highs here, the all-time highs, we had absolutely no bearish divergence in this move higher through the second week in December. None at all. So I said any softening in price is probably going to be met by buyers, because it shows that there is no propensity to sell right now. Granted, from the lows right here that we made in the U.S. presidential election lows, we had a lock limit down overnight action. Now we were trading. I had folks in our group up in our chat room, and we were trading and made some great trades, made some good money on this move. But you can see where it actually closed the day right there, and then it opened the next day right there. It opened up, but not without a lot of fun right in that area there in overnight hours in the futures market. But you can see here that we're digesting this move, all right, this big move off of these lows here, back up here. That's all we're doing right now. I don't see anything that is going to suggest, at least over the next month or so, according to the charts, of having this roll over. Now, we do have some existential events that could happen. I've heard in the press a lot of people say, you know, buy the news that Trump won and then sell the inauguration, you know. And if you look at President Reagan, when he was elected, and I just went back and looked at the stats there, when Reagan was elected president, he had, you know, run on the campaign of doing a lot more stimulus in the markets, tax cuts and things like that. And when he won, the markets moved up about 8 or 9%. And then after the inauguration, over the next 4 or 5 months, the market sold off a pretty good bit. And then they finally recovered and came back up. So there's a lot of talk that says after the inauguration, end of January, early February, we're going to have a move lower, and then it's going to consolidate, and then we're going to see what happens. If that does happen, and let me just clear my screen up here. What I would do is I would run some fib retracements on here to say what would be a normalized area that we could expect, right? You can see on my screen here, if I take everything off, all of this volume right here. These are buyers sitting in here in wait, you know, and let me just, I should have just extended it over like this here. But there is a lot of volume at this price level right here. I would not be surprised to see us kind of, you know, if there is a sell-off, if we do take out the 50 EMA, for us to come down and find some good consolidation here, and then you will probably see at that point in time some buyers step in, and that would actually be a good place to buy, provided that the Trump administration can do a lot of what he says he wants to do, and he doesn't get any pushback from members of his own party. There will be a lot of stimulus. But by the same token, there's going to be inflation coming to bear, and we're going to have the interest rates in the Fed and Aunt B, a.k.a. Janet Yellen, come out, and she's going to offer her recipe for blueberry pie. And if it's full of sugar and sweets, which I don't think it will be this time, meaning being dovish, she's going to be a little bit more hawkish. And I think they may be pushed up against the corner. If Trump gets a lot of his stimulus actions approved, you're going to see inflation just all of a sudden out of nowhere start ramping up really quick. The bonds will fall off. interest rates will start coming up, and now you're going to have earnings per share and higher PE ratios competing with a higher interest rate in the bond market, which could then in turn drive equity surprisingly to the downside. Right, and we're fairly richly valued right now. So rather than trying to guess, what we're all about here is we look at key price levels, we look at where we want to be, and then we see if these are taken out. We follow the price action, we always have. I would basically look right now roughly at around the 2190 to 2000 area, right in that there, right that area, right there as primary near-term support for us. I would not be surprised at all to find us somewhere down in this area here in February. Okay, you can see we got a huge resistance area back here. It took us a while, almost 2 months or a month and a month to get over that area. In fact, our first run at it, we couldn't hit it. I mean, it went all the way back to here, truth be told. So really starting in the July, and then we finally we weren't able to really clear this area until in the after Trump, right? Because this was the election results right there. And then only with that positive stimulus from Trump did we actually clear this entire hurdle area here. So when you've got a resistance area like this that imposes such difficulty on a rising price, I do believe that it's going to serve also as a solid area of support, providing lift to the market, right? I think it's just going to provide great lift to the market to the upside, or at least support here, because you can see all of that volume right there just sitting there. Now, should this break, we're definitely going to come down and test this 2080 area, and then possibly even come down and test this area. I don't see that happening in Q1, okay? I don't see it happening, but doesn't matter what I see and what I don't see or what the charts say. Remember, charts, even with technical indicators, the best you're going to get is anywhere from about a 62 to a 65% probability of an expected move. Okay, that's about the best you're going to get. And for those of you that trade options, which is what we do, and by the way, if you do trade options, then I strongly encourage you to check out our Secret Trader, because that's a lot of what we do, options on commodities, with futures, options on equities, ETFs, indexes. And I think it's going to be a good way to play in 2017, because there's going to be a lot of surprising moves. And I think there's going to be some surprising moves in both the commodity market and the currency market that are going to catch people off guard a little bit. But this is kind of where I see the near-term support, anywhere from 2180 to 2200. We're going to be running a little bit soft in that area there. You can see, much like it took us a while to clear this area. In fact, let me just get this off the screen here and clean it up just a little bit for you here. So you can see right in this area right here, it took us a while to clear it. So we're just now in this area right here. And in fact, the longer we stay at this area, the more the odds favor a little bit of a downward move like we had here. And then if you notice, we came back up, we challenged it again. We stayed here for a while, and then we just sold off into the, we sold off before the election. The 200 EMA caught us. We moved up, and then boom, this is kind of where we started back from again. And then if I were to extend this over, you can see how we broke out. We came back for the all too familiar retest, and then boom, now we're at another level. So we can look for this pattern right here to kind of simulate this pattern right there. It generally happens, and again, these patterns are nothing more than a reflection of fear and greed in the marketplace and buying habits and patterns of all the market participants. So that's why patterns tend to repeat themselves, because we're human. Now, you got a lot of algos in there, but believe it or not, algos are starting to take on human tendencies. Why? Because algos also play off key price levels, volume at price levels, just like humans do. And the more that algos start playing in the market, surprisingly, it adds that human flavor of, or touch of, key price levels. So that's why these patterns continue to repeat themselves. So the odds, as I say, favor a little bit of a softening in price. I don't see a lot really goosing us that much higher. We remember in 2017, we've got to have much stronger earnings earnings per share, and they're forecasted to be up a lot stronger. We're expected to see earnings growth of over 14% in 2017. We're expecting to see that happen. I don't think it's going to happen. I think Barron's called for maybe 7%. But I don't see 14%, but that puts a lot of upward pressure. Now, we just had the bank earnings come out this past Friday. It was a little bit of a mixed bag. Markets opened strong, sold off, and then finished just slightly up. I think the E-minis were up, about 7 points for the day. The Russell was up 15 points. The SPX cash index was up $4.20. So a relatively benign day, actually. But this is kind of where we're sitting right now, guys. If we look at the, let's come over and look at the Russell here for a minute. You can see with the Russell, we have not made the highs. We have not passed the 2016 highs in 2017. Like we did in the S&P. We made the highs in the Russell on December the 12th, and we've just been in, again, like the E-minis, we've been in this very orderly downward trek here. Orderly meaning volatility is still very, very low. So it's just, we're just very subtly making lower lows, and we're very subtly making these lower highs, right? And again, that's generally what you see in a very bullish market. And again, you can see with the Russell futures, we actually were in the red here for a little bit in time on the night of the elections. And then just like the S&P, we opened here, but we closed here. I'm sorry, we closed here going into the election, and then we opened up here on the next day. So the markets did a complete reversal. Global markets did a complete reversal. So you can see this working off this very gradual down move. And this MACD pattern here suggests more of a consolidation period before we start moving back up again. So again, near term, I think we're going to, if we move up, it's not going to be one of these rocket ships up. I think earnings here for Q4 earnings, that are, kicked off this past Friday. And by the way, this is the first quarter that we don't have the official kickoff with Alcoa. They broke up into a couple of different companies early November. So now the kickoff actually started officially this Friday with a bunch of bank stocks, PNC, Bank of America, Wells Fargo, JP Morgan Chase. So this promises to be a very interesting year for financials. And we're going to follow it very closely. But we had a really good move in small cap and mid cap. With a stronger dollar, small cap and mid cap benefit a little bit better because they don't have the exposure offshore that, say, a lot of the S&P 500 and Dow companies do. A larger percentage of their profits come from offshore, yet small cap, mid cap, it's just the opposite. So that is a little bit about the Russell. And then, of course, if we look at NASDAQ, which has been on a tear recently, making new highs. In fact, I'll probably have to raise it up here. If I look at my chart here, and let's come over here, you can see we actually made a new all-time high with NASDAQ on Friday in the close. All right, you can see the dot-com bubble high I've got in this green dash line here. You can see the 2017 open, which was right in this area here. And then we went above the dot-com bubble, and now we're up at 2017 highs. You can see the 2016 high price. So I'm going to change the wording here. So we actually took out 2016. So NASDAQ is making up because it was following everybody else through the fourth quarter. And then it's now moved much higher. And you can also see here, and I will point this out, you can see as we've been making new highs here that we do not have bearish divergence. So that again suggests that any sell-off here is going to be pretty much like the Russell and the others, giving us kind of like a bull flag, and it just kind of does an orderly move, and then boom, up we go like that. So I would not be surprised to see something like this pattern set up here too. But NASDAQ is on fire right now. And then, of course, if we look at the Dow, it was up a measly 15 points. You can see here on the Dow, I've got some Fibonacci extensions, which I'll take off my screen here. But you can see the 2016 high that was made on the third week of December. And then we hit it again back on January the 6th. We just have not been able to pass above it. So we're just, again, in a consolidation mode here. Okay, the markets are waiting to digest what the Trump administration is going to be able to get through. It's waiting to digest the Q4 earnings. And keep in mind, the earnings projections for 2017 are much richer than they've been before. We've been in an earnings recession for the past 5 quarters. And this will be probably, we'll bounce out of it clearly on the Q4 earnings here. But we're in this very slow grind. All right. Now, if we look at volatility, volatility is, as we start this year, near all-time lows. I mean, we're down around, what did vol end with on Friday? 11.23. Folks, when you get vol this low at the beginning of the year with a new administration coming in, especially a Trump administration, which is going to be a little bit different, maybe a lot different, we can expect more volatility in the market. So, you know, next week may be a week to look at going long with the inauguration of Trump on January 20th, which is this coming Friday. May be the week to look at going long some volatility. So in our secret trader, for our members that have signed up and folks that are not members of our user group but elected to sign up with our secret trader, we're going to look at some long positions in volatility next week. I think it could be very interesting. And then, of course, if we come down and we look at the bond market, you can see the bond market is continuing. It hit a nice round number of 152 here. This pattern here suggests that the market is going to go lower. We got a 3, 4, 5 pattern. That's a typical Elliott wave pattern. Any kind of counter trend move right here has just been met by selling. I mean, that's really all it's been. And I think that is going to continue here. Now, my line is not that straight, but you guys get the idea. I think I wasn't expecting this. That red line is the 50 EMA. We couldn't get up above it. It gave us a 3-leg, a 4-leg. We're looking for a 5-leg somewhere down in that area there. So it could be choppy, but we could break the downside of this channel again and end up back down here much lower, okay? And that would entail a grinding higher for the U.S. markets. And as the data starts to come out from the U.S. government, more signs of inflation. We've got more Feds getting up to the podium. A Federal Reserve bankers never walked away from an empty mic. They always love to talk, and they all say the different things, which creates more confusion in the market. But basically, they're all kind of coming out and saying that they could see 3 or 4 rate hikes for 2017. The official policy is 3, but we could see 4. Yellen is going to be speaking again this week, so Aunt B's going to come out with her recipe for blueberry pie, and let's see if all the other chefs in the kitchen agree with her. So that's kind of where we're sitting there. We've also got some interesting action in the dollar, the yen, the British pound that we're looking at. If we look at the Mexican peso, this guy is just, it is ugly, ugly, ugly. We had our 3, 4, 5 pattern here. We've got a little bit of a divergence here, so I think we could get a little bit of a counter trend rally right in this area right here. You know, we're just, you know, much like we had this counter trend rally right there back to the upside, or this counter trend rally right there, right? But don't get lulled into this. I think we can get this little rally, and then the question becomes, if we can get another test right here and then take out that prior high, then I'd be willing to go long. I'm going to be a contrarian on the Mexican peso here. I think this could be an interesting long opportunity. Not yet, but we're going to watch it and see. And then, of course, we got the Canadian dollar, the Australian dollar, and a few others. The yen has been on a tear to the downside. You can see which has been very bullish for the Nikkei, but the yen has been following the U.S. bond market. We've got the same kind of pattern setting up. I think it could roll back over again. So we continue to be bullish the Nikkei or Japanese stocks and short the yen. Gold is going to be very interesting. I'm really excited about gold for 2017. I think this pattern is, believe it or not, a counter trend rally. I think it could roll back over, but if we can get another rollover and a little bit better pattern down here, I'd be more of a stronger buyer of gold. I've said, and I'm on record as saying, that gold's going to finish the year higher than where we went in 2017. So gold and silver to me look very interesting for the year. And then of course oil, well, we got to play on in oil and we got to play on in gold right now in our secret trader. I think with oil, I don't see the highs getting much more than the mid 50 area, the high 50s, and I don't see it going much lower than the mid 40s for now, right? Right now, all eyes are on whether OPEC can maintain their production cuts, and they're going to come out and do an official report on it at the end of January going into February. So let's see how that thing shakes itself out. And then, of course, we got the agriculture market. We're looking at some plays in the ags. We've got plays in the soft market via orange juice. We're looking at some of the others in the meat market. So this year is going to be a very interesting year with some potential seismic shifts between debt and equity and currencies. Is going to be an interesting dynamic. If you're not a member of our group, I highly encourage you to come in and check out some of our things that we have going on there. You can just click on any one of the links that you got on this or below in this blog and check us out. Have a great weekend, everybody, and this is going to be a long holiday weekend for all of you that are not in the U.S. Monday's a holiday for us. It's a federal holiday, Martin Luther King Day, so the U.S. markets will be closed. We will be back at you on Tuesday for all of our members. I will see you Sunday night. We'll do a quick review of the trades that we've already entered thus far and just a quick overview of the markets for the coming week. Have a great weekend, everybody. Take care now.